If you don't understand implied volatility, you're flying blind in the options market, pricing contracts with a number you can't see and betting on outcomes you haven't measured. This is the MadBrooks professor. AI generated, not financial advice. Historical volatility tells you what happened. Implied volatility tells you what the market expects to happen. The difference matters because options are forward-looking instruments, and you're not buying yesterday's movement. You're buying the right to participate in tomorrow's chaos, and implied volatility is how the market prices that chaos right now. Historical volatility is straightforward. Take a stock's closing prices over a period, say 30 days or 90 days, calculate the standard deviation of those returns, annualize it, and you've got a number. That number describes how much the stock actually moved. It's backward-looking, empirical, clean. If a stock has 20% historical volatility over the past month, that stock's daily return scattered around its average by an amount that, when annualized, equals 20%. Done. Implied volatility works differently. It's not calculated from price history. It's extracted from option prices. When you see an option trading in the market for $3.50, that price embeds an expectation about future volatility. The Black-Scholes model and its variants take inputs we can observe: stock price, strike price, time to expiration, interest rates, dividends. The one thing we can't observe is volatility between now and expiration, so we reverse engineer it. We plug in the options market price and solve backward for the volatility that makes the model spit out that price. That backing out process gives us implied volatility. This means implied volatility is a forecast embedded in option premiums. It's the market's collective judgment about how much the underlying will move before expiration. When implied volatility is high, options are expensive because the market expects large moves. When it's low, options are cheap because the market expects the stock to sit still. You're not buying volatility directly, but you are buying contracts whose prices rise and fall as that expectation changes. Here's where traders trip up. They see an option with 40% implied volatility and think that sounds high, so they sell premium. Or they see 15% and think it's low, so they buy. Absolute levels mean nothing without context. 40% IV on a biotech stock 3 days before FDA approval might be historically cheap. 15% on a utility stock might be rich. You need to know where implied volatility stands relative to its own range. That's why IV rank matters. IV rank compares current implied volatility to its range over the past year. If a stock's IV has been between 20 and 60% over 12 months and it's sitting at 55 right now, that's a high IV rank, maybe 90%. The current level is near the top of its historical range. If it's at 25, that's a low rank, maybe 10%. Same stock, different context, different strategies. When IV rank is high, you sell premium. Elevated implied volatility means options are expensive relative to their usual prices. Selling a covered call, a cash-secured put, an iron condor, anything that collects premium and profits from time decay becomes more attractive. You're getting paid more than normal to take on the same risk. If implied volatility drops back toward average, those options lose value even if the stock doesn't move, and you profit from the contraction. When IV rank is low, you buy premium. Options are cheap relative to their usual cost. Buying a call or put gives you leverage to a big move without overpaying for the privilege. If implied volatility expands, even if the stock hasn't moved yet, your option gains value. You profit from the volatility expansion itself, not just directional movement. Let me make this concrete. Take a stock trading at $100. Its implied volatility sits at 30%, and its IV rank is 85%. That means 30% IV is near the top of where it's been all year. You sell a 45 days to expiration put at the 95 strike for $2. You're collecting premium in a high IV environment. 2 weeks pass. The stock is still at 100, hasn't moved, but implied volatility drops from 30 to 22%. The put you sold for $2 is now worth $1. You buy it back, pocket $1 per share, and you made money on volatility compression without the stock moving in your favor. Flip it. Same stock, same $100 price, but now implied volatility is 18% and IV rank is 15%. Options are cheap. You buy a call at the 105 strike for 150. The next week, earnings are announced, and even though the stock only moves to 102, implied volatility spikes to 28% because the market reprices uncertainty. Your call is now worth $3. You didn't need the big directional move. The volatility expansion paid you. This is why professional option traders track IV rank and IV percentile religiously. They're not guessing whether volatility feels high or low. They're measuring it against its range and deploying strategies that profit from mean reversion. Implied volatility is mean reverting. It spikes during uncertainty and fear, then contracts as the market calms. It doesn't stay pinned at extremes. If you sell when it's stretched and buy when it's compressed, you're positioning yourself on the right side of that reversion. Now, implied volatility isn't a perfect forecast. Just because the market expects 30% volatility doesn't mean the stock will realize 30%. Often, implied exceeds realized because option buyers pay a premium for protection and leverage. The market tends to overestimate movement, especially around events. Earnings, FDA decisions, elections, these catalysts inflate implied volatility beforehand. After the event, IV collapses whether the stock moved or not. That crush is predictable and tradable. The difference between historical and implied also shows up in volatility skew. Out-of-the-money puts often carry higher implied volatility than at-the-money options or out-of-the-money calls. This skew reflects demand for downside protection. Investors fear crashes more than they fear missing rallies, so put premiums embed that fear. When you see skew, you're seeing implied volatility's role as a sentiment gauge, not just a pricing input. You also need to respect the limitations of implied volatility. It assumes a log-normal distribution of returns and constant volatility until expiration. Markets don't behave that way. Volatility clusters. Calm periods follow calm periods. Wild periods follow wild periods. Black-Scholes doesn't capture that. So implied volatility is useful but not omniscient. It's the market's best guess, not a prophecy. When evaluating premium, stop asking if an option is expensive in dollar terms. Ask if it's expensive relative to its volatility history. A $10 option can be cheap, and a 50-cent option can be expensive depending on IV rank. Context is everything. Run the numbers. Compare current implied to its range. Decide if you're getting paid enough to sell or paying little enough to buy. Options are volatility instruments dressed up as directional bets. If you ignore implied volatility, you're missing the pricing mechanism. If you ignore IV rank, you're guessing instead of measuring. The traders who win consistently don't have better market predictions. They have better volatility positioning. They sell high IV, buy low IV, and let mean reversion do the work. See you Wednesday. Implied volatility is the market's price for uncertainty. An IV rank tells you whether you're buying wholesale or paying retail.